Where this thing going by? If I really drag this line out, and well, clearly is because this market here and this trend line and but these fractals here. So let me follow the stochastic. But no, then the RSI seeing something different. But God, this chart slow boy. Alright, so I see in here this fractal seeing, yeah, but no, but then the trend line. How am I gonna read this, boy? Wow, there's a lot of information here, boy. Alright, you know what? I think I seen a trade right here. Really? Really? Alright, so today, what I'm gonna be doing is I'm gonna be outlining how beginners trade. And what I really want to talk about is a lot of traders. I know I'm making fun of people who use indicators. That's not the purpose of this. If you use indicators to trade, nothing is wrong with that. I use moving averages a lot of the time in my own trading. The point is, I have a reason for using moving averages. A lot of people who charts look like this, they cannot explain why they have each of these indicators on. A lot of people don't even know what they do, right? Here's my problem with this. If I asked you to go and look for a camshaft for an engine, would you be able to tell me what it is? Would you be able to go and find it? Probably not. A lot of people, a lot of beginners think that they come into this market, into this industry, and they're going to make money because it's just as easy as going into a buy, going into a sell, and that's it, right? A lot of people come into this industry looking to get into a trade to make money. But you can't get into a trade if you don't know what a trade looks like, right? Just like if it is you don't know what a turbocharger for an engine looks like, you're not going to know what to look for, and therefore you're not going to be able to find it. So by looking for a trade that you don't even know what the trade looks like, obviously you have a problem, right? So my advice to you, if you are a beginner, remove all of the indicators, everything, right? To make this easy, right click on the chart, remove drawings, right? You come down to this thing. If you're using TradingView, you come right here, object tree, and remove all of this, right? You could, but I just have the moving averages here because that's all I use. What actually happens is the chart is a lot cleaner. It's a lot easier to read. And the main thing that you want to be able to read is actually the chart, right? You want to read the price action that is actually happening. Price action is the action of price. Therefore, you don't need indicators or anything, even moving averages. You don't need them to be able to read the action of price. How do we do this? By understanding and utilizing market structure, right? Now, a lot of people throw that word around, market structure, all crazy like, right? They just throw it around thinking that, it's just as easy as saying, well, I trade market structure. You need to understand what market structure is. Market structure is a combination of elements coming together to create the chart, right? So, long story short, by just drawing a trend line here and saying, yeah, that's market structure, that is incorrect. Market structure is everything that you're seeing on all time frames, taking all things into consideration, right? The reason why I'm telling you this is how you want to read a chart. You want to read a chart simply by understanding first and foremost what is the overall direction, right? Now, I can go so deep into this, like literally, I could go extremely deep into this, but I will run out of time, right? The first and most important thing you must do is understand the direction. Most traders, again, especially beginners, and if I'm talking to you, I want you to listen. Most traders tend to look for an entry first. Before they even begin to understand where the market is going, they want to enter. So it kind of come like you're doing it like this. Or it looks like it's going to sell here. And then you enter for the sell and then you start to question yourself. You start to ask, I wonder if it's really going to sell. You should ask that question before you enter the trade. So the first and most important thing is before you even look to enter a trade, understand or try to understand where the market is going. The market can only go one of two, or let's just say three directions: up, down, or sideways. 90 something percent of the time, it will be going sideways. But the other 10%-ish of the time, it would be either going up or down. These are what we call trending markets, or what I should say the masses call trending markets. I like to look at it as momentum-based markets, right? Because you can have momentum without a trend, but you can't have a trend without momentum, right? So that's what I'm saying. I like to look at it as momentum-based markets, right? Once you have identified where you think the market is going, whether it's going down or whether it's going up, you then need to identify if the market is going to possibly reverse at a specific area. Where it would typically reverse is if it's going down, it would typically reverse at a low. If it's going up, it would typically reverse at a high. The reason for that is if it's in the middle of the range, if let's just say the market is right here, I wouldn't say this is a reversal because it still has more room to go to the downside. So you typically want to see the market get to an extreme low, and you know an extreme low by seeing big rejections to one specific area multiple times. Well, 2 times in particular. What it typically looks like is at a low, it looks like a W pattern. At a high, it looks like an M pattern, right? There's a variation of this, and it is called a head and shoulders or inverse head and shoulders. Head and shoulders is seen at a high. Inverse head and shoulders is seen at a low. A head and shoulders looks something like this, where there's a shoulder, a head, another shoulder, and that's a reversal pattern. An inverse, so this is at a high. An inverse head and shoulder is seen at a low. So you have a shoulder, a head, another shoulder, and then it reverses. And this is seen at a low, right? So if the market is going down, this is where you typically see an inverse head and shoulders. If the market is going up, this is where you typically see a head and shoulders pattern. So if you don't see something like a head and shoulders or an M at a high, or you don't see a inverse head and shoulders or a W at a low, it's probably not going to reverse. And I don't want you to treat the market like it is a reversal. Try to learn to treat the market like it is going to continue to go down. Think about it. If the market is not showing you signs that it is going to go down even, it's not going to reverse, and it's showing you signs that it is most likely going to continue, why would you treat it like anything else? If you ever heard that if it smells like a cat, it sounds like a cat, it meows like a cat, it's probably a cat. That's what I want you to do. One of the laws that I have learned, that I've created basically, right, and I've learned from being in the market for so long, right, is don't ever go against the momentum that you're seeing unless a reversal is clear. Once you can do that, you'll be very surprised as to the kind of trades that you can get, because you'll never make money faster than when the market is already doing what you want it to do before you get into the trade. So if the market is selling and you want it to sell, that's the best time to get into it. Not contrary to popular belief, buying low and selling high. You're guessing. Let's be real. Use the details and the data that you're seeing. The market is already selling. You want it to sell. It's already selling. Sell it. You understand? Now there's specifics in terms of entries. You can't just sell any and everywhere, right? And this is why I say I will run out of time trying to explain this. But theoretically, if the market is already selling, that's where you want to get in, when it is already selling. If the market is selling and you looking to buy, unless it is reversing, that's a very dangerous thing to do. And most beginners get this wrong. Most beginners, what they end up doing is they end up trying to buy at the most extreme low or sell at the most extreme high. And they get it sometimes, and they think that they have trading figured out. And by the way, this doesn't just apply to Forex. This applies to all trading, right? All trading, right? You're going to lose trades. Acknowledge that. But the goal is to make sure that when you do get a trade, that it's in momentum, meaning that you're getting the trade and it's already going in your favor. It's easier to make money. Let me not say easier. Let me change that word. It's simpler to make money. Yeah? So these are some of the mistakes I think a lot of beginners make. And I think by simply just listening to this video, that, you just repeat it. Listen to it a few times. Send it to somebody who you know is probably making these mistakes. Share it with your friends. The main thing is that if you're making any of these mistakes and you're not where you want to be, this is probably why. I want to make something very, very clear today. That thing that they say in the industry, come and earn while you learn, that's not a real thing. Nowhere else in the world, no other industry in the world is going to allow you to earn a substantial amount of money while you learn. Something is going to suffer. either the earning or the learning. You might gonna make money, yeah, probably. But in this industry, you have to learn before you earn. Because you need to learn what it is you're looking at. Understand what you're looking at before you try to get into the trade. Because if you do not, guess what? You're gonna end up like everybody else, injecting liquidity into the market. And that liquidity is injected into the market via your account. You don't want that.